Hi, everyone. The topic for this video is analysis and accounting. We're kind of doing two topics together in one video this week. The way in which I usually like to present the idea of analysis and budgeting is to talk about analysis from the different perspectives of why we analyze a budget. So you're going to break up the discussion into doing budget analysis for the purpose of forecasting revenues, for cost benefit analysis, for break-even analysis, for growth rate projections, and just kind of show you some of the tools that you can use to analyze budgets for all the different purposes that we want to use budget analysis for. So one of the first reasons why we analyze budgets is we do it for the purpose of forecasting revenues. Is obviously before we can know how much money we are going to spend in a future year, we have to have an idea of how much revenue we are generating. When we forecast revenues, we can do it in a variety of different ways. And we can forecast revenues from the very simple approach to a much more complex and much more involved way to forecast revenues. So one of the simplest ways in which you can forecast revenues is through what we call univariate analysis. Univariate analysis, we will not use any additional variables to forecast our revenue, and we'll base our revenue projections for a future year essentially on what we generated in previous years. So two very basic univariate approaches to forecasting revenue are what we call prior moving averages and prior moving changes. Prior moving averages is a very simple approach where we will take usually our preceding 3 years of revenue. We will then develop an average of those 3 years of revenue generation, and then we will use that average for our forecast for the next year. Now, what's attractive about PMA or prior moving averages is it's a very simple approach to use. The disadvantage, obviously, is that it's inaccurate. And typically, you are going to have serial under projections of your revenue, especially if you're trying to project revenue from an increasing revenue source such as property tax revenue. When you take a look at property tax revenue longitudinally, what you will see is typically every year property tax revenue will increase, and that's tied to the increase in the assessed valuation of real property. So if you're using your preceding 3 years and using that average to then forecast the amount of property tax revenue you're going to generate next year, you will probably be under forecasting. And that's one of the major problems with prior moving averages. Despite that, though, we see a lot of local governments use that approach because it's a very quick and very simple type of revenue forecasting approach. The sister approach to prior moving averages is what we call prior moving changes. Similar type of idea, but with prior moving changes, you will look at the percent change in revenue between your preceding 3 years, take the average percent change, apply that to your final year of revenue, and then use that as your projection for next year. It might be a little bit more accurate than prior moving averages, but again, you're not taking into account any additional variables in making your revenue projection. So say, for instance, your jurisdiction is losing a major corporation and your corporate property tax base is taking a hit. Obviously, a univariate approach won't embrace that change in your property tax valuation, so you would need something a little bit more sophisticated to take that into account. So a little bit more sophisticated approach to revenue forecasting is what we call bivariate or deterministic modeling. If you were in the world of social science research, you would refer to it probably as bivariate regression analysis. Here in the world of public budgeting, we call it deterministic modeling, where our forecast of the amount of revenue we're going to generate next year is being determined by one additional variable. So an example would be change in gross domestic product. So you'll take the change in the GDP, and you'll use that as your variable to then predict the amount of revenue you'll generate next year. Deterministic modeling model is a very simple one. It's one that you're very familiar with from earlier days of algebra, and you see it there on the screen for you. Your X is going to be that additional variable, so that will be your GDP. You know your B is your slope, that's your regression line, the incline or the decline in your regression. So that's defined as for every 1 unit change in your gross domestic product, here is the corresponding change in the amount of revenue you can anticipate generating. So for every 1 percentage point increase in GDP, here is the corresponding increase we would anticipate in the amount of revenue we'll generate. For every 1 unit, 1 percentage point decrease in GDP, here's the corresponding decrease that we would anticipate seeing in the amount of revenue that we're generating. So again, deterministic modeling, we're using changes in gross domestic product or whatever independent variable you choose to then determine the amount of revenue you anticipate generating in a future year. Again, a very simplistic type of process, but one that is a bit of an improvement over prior moving averages and prior moving changes. Then you can get a little bit more sophisticated. You can move into the world of multiple regression analysis. And if you've had statistics courses before, you have probably talked about multiple regression analysis. In multiple regression, what we are trying to do is we are trying to predict a dependent variable using a combination of independent variables. So instead of just using GDP, we might add some other independent variables in there as well. And as we add those additional independent variables, hopefully those independent variables will help us develop a more accurate and more precise forecast of how much revenue we'll end up generating. So all that combination of all those independent variables will hopefully help us explain and predict our dependent variable, which is the amount of revenue that we're going to forecast. You will notice in that multiple regression equation on the screen that every one of those x's will then serve for as another independent variable. So the x1, the x2, the x3, those are all different independent variables. The slopes then become what we call partial slopes, in that, for instance, the B1, the partial slope, is for every 1 unit change in, say, GDP, here's the corresponding change in the amount of revenue we're generating, controlling for all these other influences. So not only will it allow you to generate your, to determine your increase in property generation or revenue generation, whatever your source is, more accurately, it will also allow you to parcel out the impacts of each one of those separate independent variables. So you can see, does GDP have more of an impact upon property tax revenue generation than perhaps, we'll say, corporate property valuation, and so on and so on. So you can use all these different variables to help you forecast the amount of revenue that you are going to be generating. But you notice at the end of that equation, you've got that little e. That e stands for an error term. So typically when we do multiple regression in forecasting revenue, we'll have some unexplained variation. We'll have some unexplained changes in the amount of revenue that we are generating that's not explained by the combination of all these other independent variables. In basic multiple regression, such as ordinary least squares regression, what we'll do is we'll just throw all that unexplained variation into that error term and be done with it, and we won't worry too much about it. The problem is that sometimes we'll end up with some very inexact forecasts of our revenue. So we really do need to then dig into that error term and try and determine what really is in that error term. To dig into that error term, we would need to move into another statistical category, if you will, another category of tools known as econometrics. And it's beyond the scope of this class to really get into econometrics, but just to kind of give you a flavor, with econometrics, what we are doing is a similar approach to multiple regression, but we're really getting into that error term. We're asking the question, what is in that error term? We deconstruct that error term to try and give us a little bit more precision when it comes to forecasting our revenue. Econometrics is very useful in revenue forecasting when our tax sources are not independent of each other. Now, as you know, in multiple regression, if you remember from your stats classes, in order to use a lot of different types of multiple regression analysis, you need to have independence between your different variables. If your different variables are not independent of each other, then you have something called multicollinearity, and you're not going to be able to use multiple regression very well. Econometrics kind of allows us to get around that issue, because we can use econometrics even when our tax sources are dependent upon each other. And it's certainly possible that your different tax sources will be dependent upon each other. Sales tax revenue is oftentimes dependent upon income tax revenue. If people aren't working, they're not generating incomes, they don't have disposable income. If they lack disposable income, they're not going to be making purchases, and your sales tax revenue will go down. Econometrics is a much more sophisticated way of forecasting revenue as compared to multiple regression. And just to anecdotally give you an example, back when I taught in Illinois, I taught a public budgeting course. And when I first started teaching in Illinois, I would get contacted by the State Bureau of the Budget at the end of every semester, asking me if I had a student or a group of students who were ready to apply for a budget analyst position. And for those folks who are applying for a budget analyst position, the requirement was they had to have completed their master's degree, they had to have completed the public budgeting course, and they had to have a working knowledge of multiple regression, because that's what the State Bureau of the Budget used in forecasting its revenue and analyzing its budgets. By the time I left Illinois 4 years later, the Bureau of the Budget was asking me for students who had their master's degrees, who had completed the budgeting course, and had a working knowledge of econometrics. And just in that 4-year period of time, budget analysts in the state of Illinois had to have econometrics in addition to multiple regression in order to get those positions as budget analysts. So the progression really has been toward more sophistication in terms of doing revenue forecasting. And you'll see the level of professionalism and the level of sophistication increases as you move up your intergovernmental tiers. So at the local level of government, very common to see prior moving averages, prior moving changes. Move up to the state level, you're probably going to see multiple regression analysis and maybe a little econometrics. You get to the federal level, and you're certainly going to be in the world of econometrics. You're also going to be in the world of what we call microdata simulation models. Microdata simulation models will help us try and forecast the impact of changes in tax laws on the behavior of taxpayers. So ostensibly, if you're changing tax law, you're going to be reducing the amount of tax revenue you're going to be generating, at least initially. But the hope is that you will stimulate certain types of activities on the part of your taxpayers so that they will be stimulated to get more involved in the economy. And by getting more involved in the economy, they'll stimulate the economy, and they'll then in turn generate more revenue. So even by cutting taxes, you hope to then generate more revenue in the future. So what you do is you engage in these microdata simulations. There are two different approaches you can use there. There's what's called static and dynamic scoring. Whenever you use the term scoring, what you're doing is you're trying to forecast the impact of a change in law on the behavior of citizens, on the behavior of taxpayers. So in a static type of scoring system, you would assume that the change in tax law will not have an impact upon the behavior of taxpayers. So by changing the tax law, by giving these tax cuts, you're going to reduce the amount of revenue, and you just live with it. You assume that, okay, we're going to be doing this to benefit our taxpayers, but we're going to assume it's not going to have a big impact upon their behavior, so we're just going to end up losing some tax revenue. That would be a very static scoring model. In a dynamic scoring model, we assume that this change in tax law, the reduction in tax burden, will have a positive impact upon our taxpayers and will then encourage them and stimulate them to go out there and spend more money, or to create jobs and to create businesses. And by doing that, then in future years, you'll stimulate the economy and you'll actually be able to generate more revenue in those out years. It's a dynamic type of process. In the last major tax cut we saw back in 2017, this was the major debate that was going on between Democrats and Republicans. Democrats were arguing for a static scoring system and said this tax cut would end up greatly reducing the amount of federal revenue and would then add to the federal budget deficit. You saw Republicans arguing for a dynamic scoring model, saying that it's going to stimulate the economy, and yes, we're going to lose some revenue in the near term, but in the future, in those out years, where through economic stimulation, these tax cuts will more than pay for themselves in additional federal revenue. So again, it depends on which approach you use in your microdata simulations, but whether you're a static or a dynamic adherent, it's going to really change the way in which you look at the impact that laws have on the behavior of taxpayers. But knowing how your taxpayers are going to respond to changes in tax law will help you do a better job of developing accurate predictions and forecasts of revenues in the future. And it's extremely important that we be as accurate as we possibly can be when we forecast those revenues. We can also use analysis and budgeting for the purpose of estimating costs. We not only want to forecast our revenues, we want to estimate our costs. Some costs are relatively easy to estimate. For instance, personnel costs. Personnel costs are pretty straightforward, especially if you have a step and column type of system in your civil service system. You know how long someone's been working there, you know what job class they are in. Makes it very easy for you to estimate your personnel costs. Non-personnel costs may take a little bit more work and be a little bit trickier. Maybe you'll be very lucky and it'll just be your non-personnel costs will just be a function of volume times unit price. That's a very simple type of an approach. Sometimes you'll calculate your non-personnel costs through a workload times average unit cost type of an approach. So, for instance, number of days times cost per day. Sometimes you'll want to calculate your non-personnel costs through workforce ratios. So you'll compare one thing to another. So you'll compare vehicles to staff ratios. So what's the ratio of the number of vehicles to number of staff members that we have in this location? Always, you're going to be very concerned about adjusting your costs to prior year costs. Because one of the common themes that runs through this entire video is that the value of money changes over time. And what something cost last year, it will cost something different this year, because the value of money does change. So you need to adjust your estimate of cost for this year by what it cost last year. You have to adjust to that prior year cost. So we've got a lot of tools that we use for that, things like the CPI, the Consumer Price Index, cost of doing business factor. The Bureau of Labor Statistics, the BLS, every year produces these types of adjustments that we can then use to adjust costs based upon, number one, what type of cost it is, what type of expenditure we're talking about, as well as adjust, number two, according to where you are in the country. Because the cost of doing business factor may be different in Dayton, Ohio than it is in Miami, Florida. And so you need to try and make those adjustments based upon the local economy in those areas. And so we try and estimate our costs through budget analysis as well. We also use analysis and budgeting for doing what we call a break-even analysis. Now, as a governmental organization, unless we are a government corporation or a government-sponsored enterprise, typically government corporations do not operate to make a profit. We are looking for that break-even point where our total costs equal our total revenues. We want to operate at that break-even point because if we have excess resources that we don't need to deliver this good or service, those excess resources are probably better used in another segment of society, probably better used on another program or another policy area. So it's important, if we're not a government corporation or a GSE, that we're probably going to try and operate at that break-even analysis point. Well, I'm sure, as you know, your break-even point for a government organization will be the point at which your total revenue is equivalent to your total cost. So let's go through a real quick, simple example of how our break-even analysis can work, and it's a real simple one we can get through in a couple of minutes. But let's assume that you have a waste management authority. And that waste management authority obviously has a primary responsibility for removing trash for a municipality. Let's assume that that waste management authority charges $2 per 40-gallon container that they collect. So every 40-gallon container they collect, they're charging the consumer $2 for that collection. So our total revenue would just be $2 times Q, which is our quantity. So once you know what your quantity is, you multiply it times 2, you know how much revenue you are generating. Our costs, as you know from your economics courses, will consist of fixed and variable costs. So let's assume here in this situation that for fixed costs, we have administrative costs and we have equipment lease costs. So we have $35,000 in administrative costs. We have $85,000 in equipment lease costs. So we have a total of $120,000 for our fixed costs. Again, these are fixed costs. They are not tied to the amount of the good that we are producing, the amount of containers we are collecting. These are costs irrespective of how many containers we will collect, hence their fixed costs. So we have $120,000 in fixed costs. In terms of our variable costs, again, remember variable costs are costs that will change depending upon the amount of the quantity you are producing. So let's assume we have a landfill tipping charge of $1 per container. We have a 15-cent equipment operation cost per container, and we have a 25-cent per container collection crew payment. You add all that up and you have total variable costs of $1.40 per container that you are collecting. So again, our total revenue would be set equal to 2Q, $2 times the quantity that we are collecting. Our total cost would be the combination of our fixed costs and our variable costs, so $120,000 plus 1.4Q. $120,000 is our fixed cost, 1.4Q is our variable costs. We set our total revenue equal to our total costs, as you see on the screen. So our total revenue, 2Q, equals 120,000 plus 1.4Q. And from there, it's just very simple math. Isolate the Q, subtract the 1.4 from both sides. You end up with 0.6Q equals $120,000. Isolate the Q, you divide both sides by 0.6, you end up with Q equals 200,000. In other words, if we collect 200,000 containers, charging $2 per container based upon our total fixed costs and our total variable costs, that's the point at which we will break even. So we need to collect 200,000 containers in order to break even. If we collect fewer than 200,000 containers or more than 200,000 containers, we're going to miss that break even point. So again, we do analysis to compare our revenues and our costs in order to arrive at that break-even point, which is where most government agencies would like to operate. But why else do we analyze budgets? We also analyze budgets to create these things called cost-benefit analyses. If you're a pessimist, you call it a cost-benefit analysis. If you're an optimist, you call it a benefit-cost analysis. I tend to call it a cost-benefit analysis, where we will compare the approximate costs and benefits of different courses of action. So say, for instance, we have two different projects that we are considering for our capital budget. We have a senior citizen center and we have a recreation center. That senior citizen center will impose certain costs on us for constructing that senior center. The recreation center will have a separate set of costs. The senior center will also present some benefits that will accrue from the construction of that senior center. A different set of benefits will accrue from constructing the recreation center. So what we need to do is we need to have some empirical basis for comparing the wisdom, if you will, of pursuing the senior center versus pursuing construction of the recreation center. So hopefully the cost-benefit analysis will give us some of that empirical basis for making that choice between those two different types of projects. So basically in cost-benefit analysis, what we'll do is we'll identify the objectives, the goals of each of those projects. We'll then need to identify the costs and the benefits of each of those projects. And then, which is one of the most difficult things to do, we have to then monetize the costs and the benefits. So how much will these costs and benefits mean in dollar values for the senior center versus what will they mean for the recreation center? And this is what becomes very difficult in the cost-benefit analysis, because sometimes you are comparing apples and oranges. Sometimes you are comparing, for instance, benefits that will accrue immediately for one of the projects, but then a set of benefits that will not accrue for a number of years for another project. So what you need to do is you need to come up with a way to calculate the present value of the costs and the benefits that will accrue from these two projects. Because just a real simple example is if someone gives you $1,000 on January 1st, that $1,000 you get on January 1st is more valuable to you than the $1,000 that they're going to give you the following December 31st. Why? If you get $1,000 on January 1st, you can invest that money. So by the end of the year, maybe you have $1,100 because you have earned that investment, that extra $100 in interest. So usually the present value, if you can get the money today, that's going to be more valuable than getting the money in the future. So what we need to do is, because a lot of the benefits that we're going to get from these projects are expressed in future value, so benefits you're going to get a year from now or 2 years from now, what we need to do is we need to take those future values of those benefits and we need to discount them back to the present value. So to engage in that type of discounting and cost-benefit analysis, you simply take the future value of the benefit that you're going to get, you divide it by 1 plus your prevailing rate of return. So, what could you have invested this money in for the last year in order to get interest on it, what that interest rate is, raised to the number of compounding periods. So you do that, you can take your future value, as you can see with the formula on the screen, take your future value, divide it by 1 plus your rate of return, raised to the number of compounding periods. That will then bring that future value into alignment with what it currently would be worth today. It's a process that we call discounting. So we not only have to identify our costs and our benefits, but we have to discount those costs and those benefits and discount them for the value, change in the value of money over time. We also have to discount them for risk. Whenever we are engaging in the construction of a public project, there is always risk that you have to assume. What's the risk that we don't get this project done on time? What are the risks for the surrounding area in terms of inconvenience? If we're going to build this senior center, we may be inconveniencing people because we're going to be closing off roads. There may be some interruption to the electric services, might be some interruption to the storm sewer. We're going to have all these interruptions that we have to take into account as well. Cost-benefit analysis, even though it sounds very quantitative and empirical, actually has a lot of subjectivity built into it. And just give you another example of that, whenever I teach a policy course and we talk about cost-benefit analysis, I use an example from a textbook by Weimer and Vining. And Weimer and Vining, in their text, they devote an entire chapter to giving an example of a cost-benefit analysis for increasing the taxes on alcoholic beverages. And the whole purpose of their exercise is to show the reader just how convoluted and difficult a cost-benefit analysis can be. So in their example, what they're saying is, let's look at the cost-benefit analysis of increasing taxes on alcoholic beverages. Fine. If you're going to increase the taxation on alcoholic beverages, you have to realize there are different types of beverages. So there's a different elasticity for beer, there's a different elasticity for wine, there's a different elasticity for hard liquor. As you probably remember from your economics courses, elasticity speaks to the demand that a consumer will have and how dependent that demand is on the price of that good. So if you have something that is very elastic, you increase the price, you're going to see consumption and demand go down. If you have something that's very inelastic, it doesn't matter if you keep increasing the price, consumption and demand is going to keep going up. So gasoline is an example. You increase the gas tax, it's going to have very little impact upon demand because that's a very price inelastic type of good. So different types of alcohol have different price elasticities. And they have different price elasticities depending upon the market involved. So for instance, younger people have less elasticity in terms of their demand for beer than they would have for wine or for hard liquor. Older consumers have less elasticity for hard liquor, but much more elasticity for wine and for beer. And so you not only have to know the elasticities of all these three different categories of alcoholic beverages, you have to know the elasticities for different markets for these three different types of alcoholic beverages. So you have to calculate all that in your cost-benefit analysis. Then you also have to think about what are some of the benefits of having less consumption of alcoholic beverages. So let's assume that there is elasticity built into demand. And you're going to increase the tax, which will increase the price, which means you're going to have less consumption. But what are the good things associated with less consumption of alcoholic beverages? Well, hopefully you'll have greater levels of productivity in your community and you'll have less missed days of work. Hopefully there'll be a positive impact upon health insurance costs. Hopefully there'll be a positive impact in terms of fewer drunk driving accidents. Well, let's drill down on drunk driving accidents. You can probably make a legitimate argument that if we reduce consumption through a higher price, then you'll be able to have fewer drunk driving incidents. Well, if you have fewer drunk driving incidents, obviously that's a good thing, but how do you quantify that benefit? How do you know in dollar values what that means for you? Well, it depends. It depends upon the outcome of that drunk driving accident. Did that drunk driving accident result in property costs? Well, if it resulted in property damage, then you're going to be able to reduce those costs associated with property damage, which obviously is a good thing. Maybe that drunk driving incident would have resulted in an injury to someone. Well, reducing that injury also is a benefit, and you can kind of quantify that with fewer hospitalizations associated with drunk driving. Well, maybe that drunk driving incident would have resulted in a fatality. So for that drunk driving accident not occurring, then you're not going to have that fatality. Well, then the question becomes, well, then what's the value of a human life? Well, you've got some actuarial tables that insurance companies have put together to calculate the value of a human life based upon the age of the person, based upon the person's occupation, based upon the person's lifetime earning potential, based upon the number of other people in the family that are reliant upon that person's earning potential. There are a lot of factors that can go into the calculation of the dollar value of a human life. Weimer and Vining, in their analysis, they went and they did a literature review, like most good social scientists would do, and they pulled 60 different articles that identified the value of a human life. And they came up with a range of anywhere from $60,000 per life up to a high of $8 million. Well, the range that they came up with, it really depends upon what number you pick. If you pick $3 million for the value of a human life, you're going to come to a very different result in your cost-benefit analysis than if you pick $60,000. You also then have to, when you're still keeping with this discussion of the reduction in drunk driving accidents, you also then have to think about how informed people are. So the person who's going in there and drinking and then getting in the car, they are perfectly informed about what they are doing. But as they head down the road, the person who's coming in the opposite direction, they have no idea that that person is driving drunk. So they have 0% information about the danger of the situation that they are finding themselves in. So yeah, it's just an example, not to belabor too much, but of all these different moving parts and all these different considerations that go into a cost-benefit analysis. Because of all this subjectivity and all these different moving parts, cost-benefit analysis tends to be a good supplemental tool to use in budgeting, but it really should never be used as the sole reason why we are making a decision. It's a good supplemental tool, but it is not a perfect tool to be used in exclusion. In fact, there's a very good article from a couple of decades ago by an author by the name of Carl Williams. And Williams, the title of his article is Cost-Benefit Analysis, Bastard Science or Insidious Poison in the Body Politique. And that's the argument that he makes in his article. Is just, it's a good supplemental technique, but it's never to be used as the sole reason for why you make a decision in public budgeting. But at the end of the day, with the cost-benefit analysis, what we are looking for is we're looking for some metric that we can hang our hat on to say, well, yeah, this gives us some evidence that perhaps we should be pursuing this project over this project in combination with a lot of other considerations. The statistic that is most commonly used in cost-benefit analysis is what's called the BCR. It's the benefit-cost ratio. So you simply take your net present value of your benefits and divide that by the net present value of your costs. If your benefit-cost ratio is 1.0 or above, then that is something that is probably, at least from an economic perspective, something worth pursuing. If it's less than 1.0, that means your costs exceed your benefits, and it probably is something that is not economically viable. Variation to the benefit-cost ratio is just a simple subtraction of your net present value of your costs from your net present value of your benefits. That then gives you your net present value for that course of action. But yeah, cost benefit analysis is something that's used very frequently in public budgeting. It's a frequent reason why we will analyze our budgets. But again, it's a good supplemental tool and not a tool to be used in exclusion. Well, why else do we analyze? Well, we also analyze budgetary information for the purpose of developing growth rates and projections. So what I have on the screen there for you are just two very simple calculations for how you calculate a growth rate and then how you use that growth rate to then calculate a projection, either a projection of future revenue or a projection of future expenditures. So growth rates. The formula for growth rates is on the screen for you. R is rates, so R equals XL divided by X1. XL will be the value at the last time period. X1 will be the value at the first time period. So let's say you're trying to forecast revenue and you've got 5 periods of time that you have revenue information for. XL will be the last year in your 5-year time series. X1 would be the first year in that 5-year time series. So the last year's amount of revenue divided by the first year's amount of revenue raised to the 1 divided by T power. T stands for the number of time intervals or time periods. So if we're looking at a 5-year time period, your exponent would then be 1/5, 1 divided by 5. All of that then gets subtracted from 1, and that will then give you your growth rate. So let's look at an example of how that would work. You see I've got an example on the screen there for you. Let's just, to keep it really simple, let's just say we're just looking at 2 years. So we're looking at last year's amount of revenue and the preceding year. So last year would be XL. So in our example, XL was $675,018. X1, which is the year before that, because we're only looking at 2 years here, was $648,747. So we divide those numbers, then we raise to the 1 divided by T power. Well, since we're only trying to forecast 1 year into the future, so we're using these 2 years in order to forecast 1 year into the future, then we're just going to use 1 up there, so it would become an exponent of 1. You end up with 675,018 divided by 648,747, subtracted from 1, ends up with 4.05%. So the growth rate between those 2 years was 4.05%. So revenue grew by 4.05% between those 2 years. So now that we have that growth rate, we can then take that growth rate between years and we can then apply that growth rate to our projection formula. So when we are trying to project a future value, your dependent variable then becomes the F. That's your future projection. So it becomes F equals XL, the amount of revenue in the last year that you have available, times 1 plus your growth rate, raised to the exponent of the number of years between last year's amount and what you are forecasting. So if you're forecasting 2 years in the future, then that I exponent becomes 2. 3 years in the future, it becomes 3. 4 years in the future, it becomes 4, and so on and so on. So let's assume we're going to take that revenue that we generated in that last year and our growth rate, and we're going to use that to then forecast the amount of revenue we'd anticipate generating 2 years into the future. So it becomes $675,018, that's the amount from the last year, times 1 plus 0.0405. 0.0405 is our growth rate, that 4.05%, and then raised to the second power because we are forecasting 2 years into the future. Your result then is in 2 years, based upon that last revenue figure, the $675,018, and the growth rate that we've calculated, 2 years from now, we would anticipate to generate $730,801. So we have now used our growth rate to forecast the amount of revenue we'll anticipate however many years in the future we are interested in projecting to. So again, just more examples. of how we can use analysis and budgeting to kind of get an idea of what our budgetary situation is going to look like in the future based upon information that we have collected from the past. So again, all that discussion did is just kind of introduce you to some of the different strategies that we use analysis for, and then some of the different specific tools that we will analyze our budgetary information for. Now, I'm not anticipating that you will have to do these calculations for a grade or anything like that, because again, I usually try and keep this course so that it's a level playing field regardless of the amount of budgeting experience you have coming into the course. But I do want to make you aware of some of the formulas. You know, this is the science of budgeting. And as you'll see as we go through this entire course, budgeting is both an art as well as a science. The science are these formulas and these different strategies for forecasting and the like. That's the science of budgeting. The art of budgeting is then the politics, because we do all these calculations, we go through all these formulas in order to determine if a course of action makes sense from an economic perspective. However, we know that even if something makes sense from an economic perspective, if it doesn't make sense from a political perspective, it probably is not going to happen. And the phrase I always use in this class is that political imperatives trump economic imperatives. So even if something makes a great deal of economic sense, if it doesn't make political sense for decision makers and elected officials, it probably is not going to happen. Then as we manage our money, so we manage our money by doing these different types of analysis. But we also have to match our money with transparency and with openness. And managing our money with transparency and openness moves us into this idea of governmental accounting. So whenever we manage the public's money, we are managing public taxpayer money, which means that there are rules and regulations and laws that we need to follow in terms of how we manage that money for the public. All those rules and regulations on how we manage that money, that all fits within this rubric known as governmental accounting. Now, governmental accounting is oftentimes not the most exciting topic in a budgeting course, but it is a very necessary and essential topic. Most graduate level programs in public administration will also have a separate accounting class that students will take, because there are a lot of specific rules and regulations that we just don't have the time to get into in this class. What I do want to do is just paint with some very broad brush strokes. Here are some of the different categories of things that we need to do within the realm of governmental accounting. Now, governmental accounting is, again, very much of a rule-bound and a process-bound procedure. And as a rule-bound and process-bound procedure, you have some governing authorities that will guide your activities and your behavior as you account for these public funds. The primary organization that guides our behavior in accounting is what's called GASB. It's the Government Accounting Standards Board. The Government Accounting Standards Board will publish what they call statements. And those statements they publish will then require governments to do certain types of things in accounting for their funds. So, one example is several years ago, GASB published what was called Statement Number 34. Statement Number 34 required that local governments change the way in which they account for capital assets for certain types of their funds. And it required, it was a gradually phased in type of rule, but it required a fundamental shift to the way in which we account for capital assets in some of our funds. And every few years, sometimes multiple times per year, you will get these statements from GASB that will change the way in which you have to account for your public funds. But basically what GASB does is it holds local governments accountable to what are called the Generally Accepted Accounting Principles, otherwise known as GAAP, G-A-A-P, the Generally Accepted Accounting Principles. And these Generally Accepted Accounting Principles fall into a couple of different categories. They require, number one, what we call fund-based accounting, and number two, accrual-based accounting. So let's look at both fund-based as well as accrual-based accounting, what they mean and how they work. So in fund-based accounting at its most simple level requires that governments must segregate their money into different funds to make sure that they are not double spending money. It allows you to impose control over how those monies are being spent. So there are three basic categories of funds in fund-based accounting. There are governmental funds, proprietary funds, and fiduciary funds. The first category, governmental funds, made up of a lot of different examples. So the biggest example of a governmental fund is what's called the general fund. If you deal with budgeting at your local government, your city or your county or your school district, you're very familiar with general funds. General funds typically pay for the day-to-day operations of the district. So this is where you're usually going to see your salaries, you're going to see your benefits, you're going to see supplies. Most of that comes out of what we call your general fund. General funds have fewer restrictions than a lot of the other funds we're going to talk about on this slide. So they're primarily unrestricted in the way in which you spend a lot of these general funds. But the general fund typically is the most active fund. It's the one where you're going to spend most of your time focusing on for the day-to-day functioning of the government. A second type of a governmental fund is what's called a special revenue fund. Money in the special revenue fund typically comes from a dedicated revenue source and or is being used for a dedicated type of expenditure. So say, for instance, you have a neighborhood where you want to put in a new streetlights for this neighborhood. Well, ostensibly, the people who are going to benefit the most from these new streetlights will be the people who reside daily in that neighborhood. So to pay for those streetlights, you might consider that neighborhood to be what we call an assessment district. So you create an assessment district. You then charge an incrementally higher tax rate to those people who live in that assessment district. You capture that tax increment, and you then use it to pay off the streetlights. It allows for more equity and fairness for everyone else in the city because the people who are actually benefiting are the ones who are paying for the majority of that project. Since that is special revenue that's coming in just from that assessment district and going to a special purpose, paying off those streetlights, that money will sometimes find its way into a special revenue fund. You want to segregate it from your general fund because that money is going to pay for a specific type of purpose. Another example of a governmental fund could be something like a debt service fund. Sometimes when you look at your budget, you'll see your city refers to its debt service fund as a sinking fund. Those two terms are kind of used interchangeably in local budgeting. So if you've got a debt service or a sinking fund, that's where you're going to be having the money to pay for your principal and interest payments on debt that you have issued. So whenever you borrow money, you got to repay it. You repay it out of your debt service fund. Then there's oftentimes a capital projects fund, or sometimes it's called a building fund. In that capital projects, or that building fund, the money there is earmarked for capital projects. So to pay off that city hall or pay off that recreation center, when you're actually spending the money to build that, that money is oftentimes going to come out of your capital projects fund. The money to repay it will come out of your debt service fund. But those are just examples of what we call governmental funds, your first main category of funds. And there are other examples as well, but those are kind of the four main types of governmental funds we typically see. Then your second main category are what are called proprietary funds. So usually if you are operating an enterprise, something that generates a profit, the money that is generated from the operation of that public enterprise usually goes into a proprietary fund, because that money is then earmarked for the maintenance and operation and development of the enterprise that generated that money. Now, a city can borrow from that fund. So if your general fund is going down, you need money to pay for salaries until your state money comes in. You can borrow perhaps from your enterprise fund, from one of these proprietary funds, but you always have to pay it back. You always have to pay it back within a certain period of time. So an example, in the school district where I'm on the board, we have a child development program. The Child Development Program is an enterprise program. It charges tuition and it generates a profit. Since that's an enterprise program, the profit generated from that, the revenue generated from that Child Development Program goes into that enterprise fund. Again, we have a resolution where we can borrow from that fund, but we always have to pay that money back within 6 months. Those are proprietary funds. Those are monies that are usually coming in from the operation of some type of an enterprise, some type of a profit-making type of endeavor. And not all governments will have enterprise funds. It depends upon if they're operating an enterprise or not. Like I said, my district tends to have that with the Child Development Program. Some other governments that would have a utility, a public-owned utility, that would be an example of an enterprise as well. Then your third main category are what we call fiduciary funds. Now, this is a different animal altogether, because the money in a fiduciary fund technically does not belong to the government. That money belongs to another government or to citizens or to someone else. So a classic example of that would be a pension fund. In a pension fund, which is a type of fiduciary fund, that money belongs to those pensioners. It does not belong to the government. The government's managing that money in the near term, but that money eventually will go to the pensioners. So it belongs to the pensioners. Sometimes you'll get federal or state grants, and they will have a pass-through requirement. And so say you have a federal grant that has a state pass-through requirement before it gets to the local government. That means the state government collects the money from the federal government, holds that money, will usually take an indirect cost off of that grant proceed before giving the grant proceeds to the local government. That money is fiduciary because it doesn't belong to the state, it belongs to the local government. The state is just holding and managing that money before passing it on to the local government. So that makes it fiduciary in nature. But again, the idea of having governmental, proprietary, and fiduciary funds is that we can impose some discipline in how we are managing and spending money to make sure we're not double spending money and we're not spending money in the areas where it should not be spent. Then you have a principle known as accrual-based accounting. So really there are two different types of accounting systems. There's cash-based and there's accrual. We kind of divide it up into three in governmental accounting to kind of show some of the nuances of what we call modified accrual. So usually when we talk about accounting at the state or local level of government, we usually talk about three instead of two types of accounting systems. We have cash-based accounting, and then we divide accrual accounting up into a modified and a full accrual category. So let's start with cash-based. That's the simplest type of accounting. In a cash-based system of accounting, it's probably very similar to what we do in our private lives. We consider revenues as revenues when we get them. So whenever your check goes into your checking account, you consider it as revenue at that point in time. So revenue is revenue when you receive it. Expenses or disbursements are considered expenses when the money is spent. So when you write that check and you send that check, you take that out of your balance of your checkbook, you are considering that to then be an expense. That's a cash-based system. Revenues are revenues when you get them. Expenses are expenses when you spend the money. In a modified version of accrual accounting, which a lot of local governments use, revenues are posted in the period when they are measurable and collectible. Now, what does that mean? That means that under a modified accrual system, let's say you have a fiscal year that runs from July 1st until June 30th. Your fiscal year ends on June 30th, but you have property tax revenues that are scheduled to come in on July 15th. Under a cash-based system, you would count those tax revenues against your next fiscal year because they're occurring in the new fiscal year. So you probably would end up with a deficit in your current fiscal year, which you're not allowed to have. But under a modified accrual system of accounting, you can consider that property tax revenue in your current fiscal year, even though you have not yet had it come into government coffers. Why? Because under a modified accrual system, once that money is measurable, you can go ahead and count it. Property tax revenue tends to be very measurable, and it tends to be very stable. So just because you're not going to receive it until July 15th, you know good and well you're going to get it. There's no question that you're going to get this revenue. It's just a matter of syncing it up with your current fiscal year. So under modified accrual, even though that revenue is coming in on July 15th, you can count that against your current fiscal year as an increase in your revenue and thus allow you to avoid a deficit. On the expenditure side, under modified accrual, an expenditure is when it's posted and the liability is incurred. So whenever you've incurred that liability, so you purchase something and that comes into your government coffers, it comes in your government inventory, and you then get a bill to pay for it. You get this accounts payable. Once you get that, then you consider that to be an expenditure, even if you haven't cut the check yet, even if you haven't put the check in the mail yet. So modified accrual gives us a little flexibility in terms of when revenues are revenues and when expenditures are considered expenditures. Then you have full accrual accounting. Full accrual accounting gives you even more flexibility in that revenues are posted when they are earned, not necessarily when they're collectible, but when they're earned, and expenses are posted when a good or a service is consumed. So let me give you an example, because sometimes these three get a little muddy in just talking about them. So here's a more concrete example to help illustrate the difference in the practical differences between cash-based, modified accrual, and full accrual accounting. So let's suppose a city is holding a fireworks show. It orders the fireworks, and the show is scheduled for July 4th. The fiscal year, though, runs from July 1st to June 30th. So let's say the city orders the fireworks on May 21st. So that's in the current fiscal year. The fireworks arrive in inventory with an invoice with a bill on June 15th, again in this fiscal year. The fireworks show occurs on July 4th, which is in the next fiscal year. The check is cut to pay for the fireworks on July 10th, which is the next fiscal year. Under a cash-based system, it's considered to be an expense when you cut that check. So when the check is cut on July 10th, that's when it's considered to be an expense. So it's considered an expense in the next fiscal year because it occurred after July 1st. So the expense that applies to the next fiscal year. However, under a modified accrual approach, it would be an expenditure when it becomes an accounts payable. So whenever you've received those fireworks into inventory on June 15th, along with a bill, that's when you would consider it to be an expenditure under modified accrual. So under modified accrual, it would be an expenditure applied against the current fiscal year. It's an obligation, a liability for the current fiscal year. Under full accrual, you wouldn't consider it to be an expense until the fireworks show has happened. Because on July 4th, you shoot off the fireworks have been consumed. Once they are consumed, that's when they're considered to be an expense, which would be an expense applied against the next fiscal year. So under a cash-based system and a full accrual system, the expense occurs in the next fiscal year. Under a modified accrual, the expenditure would apply to the current fiscal year, even though the show has not even happened yet. So again, it's just the way in which you count revenues as revenues and expenditures as expenditures. That being said, most local governments will account for most of their money through a modified accrual process. That's kind of the norm, with a few exceptions. Not to get too far into the weeds, but you'll see this in your examination of your city's CAFR, its Comprehensive Annual Financial Report, is that you will see that in some instances, such as for proprietary funds, so if you have an enterprise fund and you have a public enterprise that you are running that makes a profit, those proprietary funds are accounted for under full accrual accounting by GASB standards, while your other funds are usually accounted for in modified accrual. So again, it's kind of this combination. Full accrual usually for proprietary and enterprise funds, modified accrual for most of the other things that the government does. So both fund-based accounting as well as accrual accounting Those are both predicated on the need for control, to try and control the money that's being spent and what that money is being spent on. In public accounting, you also have what's called double entry accounting, which means for every single expenditure, you are going to enter that expenditure twice. You're going to enter it into a journal and you're going to enter it into a ledger. The journal is a chronological listing of all the transactions that your government has engaged in. A ledger is a listing of those same transactions, but grouped by account or category. So you should never have an expenditure that does not appear in both the journal and the ledger. Expenditures should always appear in both the journal and the ledger. Why? So that you can cross-reference and you can make sure that you're spending the money on the purposes that you're supposed to spend that money. And that's a principle known as double entry accounting. Everything gets entered in both a journal as well as a ledger. And then also to try and impose a little bit more control on our spending, we also have reporting requirements. So some governments will engage in quarterly financial reports. More than likely, though, what governments will do is they will produce this big report called a CAFR, a Comprehensive Annual Financial Report. And when you compare the CAFR to the budget is a prospective document in that the budget will tell you how much money and what the government wants to spend its money on in the next fiscal year. So budgets look forward to the next fiscal year. CAFRs are retrospective documents in that CAFRs will report on how the government actually did spend its money in that preceding fiscal year. CAFRs are usually very long documents. They can be 300, 400, 500 pages long, but they're usually very orderly documents that are broken up into different sections. Typically, you'll have an introductory section, you'll have a letter of transmittal, you'll have a summary section that'll probably be maybe 30 or 40 pages long. You'll also have this thing called a management discussion and analysis. GASB several years ago required that every government, when it produces its comprehensive annual financial report, must include a management discussion and analysis section. Because GASB realized that these CAFRs are very long documents. They're full of tables and dollars and numbers. They can be very difficult for average citizens to kind of find their way through and navigate. So what GASB required is that every local government in its CAFR include a management discussion and analysis section that in narrative, everyday terms will explain what's going on in that CAFR and give the financial position and the financial health of that city in paragraph form. So when you look at a CAFR, it's a very good practice to read that management discussion and analysis. Every CAFR should have it pursuant to GASB Statement 34. Then in a CAFR, you'll find the financial section. The financial section will have balance sheets and balancing sheets. Will give you the assets versus the liabilities, revenues versus expenditures, net position, net cash position, all those indicators of fiscal solvency you'll find there in your financial section. Then finally, the last section is a statistical section. That statistical section is there to show you trends. So you'll have population trends. You'll have tables for assessed value of property to show you the property value in that city in terms of that city's tax capacity. It'll show you tax effort rates and how well the city is collecting the tax levy that's owed to that city. It'll have the trends in terms of corporate property tax base. It'll list the major employers. It'll tell you which of those employers moved in, which of those employers moved out. And it'll give you all the background information that you need about that city. It kind of creates the context for you to then go back and understand all the fiscal solvency information that you will find within that financial section. But most of the things that you need to know about the operations of a city, you will get with the combination of the two documents. The budget, which is the prospective document, and then the CAFR, which is the retrospective document. But again, the reason that we have these financial reports is, number one, to control how governments spend public money, and number two, to provide openness and transparency, so people can see how the people's money is being spent. Another control mechanism we have in accounting is the auditing process. And all governments will be subject to audits. Now, the frequency of the audits, the type of the audits will depend upon the level of government. It will depend upon the types of funds and expenditures that are being audited. Typically, you have two broad categories of audits. You have financial or legal audits, and you have performance or management audits. Financial legal audits will look at, did the government spend the money in the legally appropriated manner? So did the government spend money in the way in which it is legally obligated to spend that money? So it's much more of a legal type of perspective. Performance-based audits or management-based audits will look at not just how we spent the money, but how well we spent the money. And we'll look at, did we spend the money efficiently and effectively in order to achieve our goals and our objectives? Now, when you read through an audit, what you're looking for in that audit is, you're looking for in that letter of transmittal from the auditor, you are looking for their findings, and you're looking for what are called issues of materiality. If you find something that rises to the level of an issue of materiality, that means it is a significant deficiency that the government has in the way in which it's managing its money. So you may see an auditor in that letter talk about a few different things, like maybe a lack of internal control, or updating the software that's being used, or something like that. But then if they say, but none of these issues rise to a material level, then the city's usually in good shape. However, if they have in their letter issues of materiality, and then they list things that are material deficiencies, that's when the government is in trouble. Those are things that the auditor is raising a red flag about and saying, this is something the public needs to be aware of. This is something that this government needs to try and address. So in those audits, you're always looking for those material issues. If they're there, it's a major red flag for you as a citizen. But the audit is there, obviously, just to account for how the money is being spent, how well the money is being spent, and make sure that governments are spending money in accordance with their legally required obligations as fiduciaries and protectors of the public money. So in general, that's our discussion of analytical tools that are used in budgeting, as well as the purposes and the processes that underlie governmental accounting. Again, I know accounting information is not always the most exciting information in the world, but hopefully this kind of demystifies some of the world of accounting. And accounting is something that should be occurring on a daily basis within an organization. It's something that should be interwoven into all the things the government does every single day. It shouldn't be something that sits at the end of the process, that is disjointed and disconnected from the day-to-day functioning of the organization.